Hey guys, Jay here. This is smarthelping.com. I've got another in-depth financial model template for you. This is in the securitization industry, and the models for a structure or essentially a loan securitization platform that connects, banks who want to offload loans and people who want to buy them through securities. And this is the middleman that's going to collect fees on everything. This entity is not going to take a whole lot of risk with, loans being defaulted on and so forth. Their main risk is making sure they do their job right. They do the administrative and legal work correctly and have everything working correctly. Um, so I'll go through the model's quite extensive. You can see we got a lot of deal assumption heavy inputs here. We've got full financial statements, income statement, balance sheet, cash flow statement. That's all connected, and I've got everything zeroed out right now. But what I'm going to do is walk through with you on every input, go through the model so you can see how it works. That's the best way for these things to try to explain. Um, so let's, and you'll get when I go over the deal assumptions, I'm going to go through every line item, and I've also put in notes for here for you guys as well. But this will explain really well what's happening and what kind of, and there's a lot of different avenues you might go. So some inputs and assumptions might not be relevant. Some maybe. It just depends. But the model's extremely flexible as far as what you can do in the industry. Okay, so let's start with the global control. Here you can name your company, and remember you're going to be able to edit any yellow cell across the entire model with blue text. Those are all editable. You get your sanity checks down here to make sure all the statements line up when you change the assumptions. So company name, length of forecast up to 60 months, include terminal value or not. If yes, it's going to take a trailing 12-month EBITDA multiple to get your exit value. And remember, this is a software platform. You're not like owning these portfolios, collecting interest on. I've done other models for that. That's different. This is a facilitating platform that's going to take fees, and that's another reason why the model only goes for 60 months and not, 10 years or 15. 60 months is a good amount for a tech platform financial forecast. Um, so we got the exit, first month of forecast. You can put this in. This just overlays across a couple of different tabs so you can see timing, but this doesn't drive anything. It's just a reference. And then cash sources, you'll be able to control this on the cap table. We'll go through that later. Income taxes, tax rates, that'll affect some things if you want to show that. If not, you can zero it out. Okay, now for the actual deal. So we'll start with software development, and this is a main capex item in software in the software industry. So you might have some initial expenses, and these you could have other things besides software in here. This just simply allows you to put like a budget. Let's say we're going to do, 1.5 million on that, maybe 5 million on something else, 500,000, maybe a 10% contingency. So here's your budget for how you're going to build it, and this is the percentage of that total cost that you're going to spend over time. So let's say it's let's just do a 6 month, or no, let's do a 5 month, so it's easy math. So 20% evenly spread out over the 5 months. That's your development period. Now it could be longer. You can actually go up to 48 months, but that's kind of you're mainly going to have this. The model is only 60 months, so if you do have an extremely long development time, you might want to just front load those at the beginning and say, okay, this is what it's going to cost, and then assume that whatever month is you're done, that's your go live month. In this case, we're just saying there's 5 months here. Month 6 will start depreciation, so we go on the capex here. It's already in month 6, and so now we go to deal assumptions. So in the deal assumptions, we've got this section to define how many new deals you're facilitating per month, and you could define that over the whole period. and then you've got all your deal assumptions, which we're going to go through, and then you've got, based on that, some key stats here I brought over, mainly all the different high-level revenue items, direct costs, gross profit, OPEX, EBITDA, so you can kind of see how changing these assumptions will affect your bottom line. And you can see right now, we just have those 7.7 million in software development costs hitting. So that's our only current item, so that's what you see here. Let's say, let's say in month 7 we're going to have a new deal. We'll just put 1. And I think it's good to model 1 to show you guys it's easier to explain what's going on. And then once you understand that, you'll see what, and it's so nice to be able to add just arbitrarily large amounts of new deals based on whatever you forecast to have happen, and all these economics will go into play, which is really awesome. So let's just do 1 for now in month 7. And we'll just do the first type. So we've got, you define your asset classes here. I just did consumer loans, mortgages, auto. So we'll do consumer here. Lead time to new deal closed. So this is going to give you a little buffer. There are some working capital things that might happen here if you have some upfront costs to get the deal structured. And then you might not, some of the fees might be post-closing, but some of the fees you might have to pay up front no matter what, and the deal might not close for a couple months. Let's say it takes 2 months. There's a little lead time there to track that working capital requirement, because that could affect cash flows, especially in the first 12 to 24 months as you're ramping up. Okay, so we'll give these a 2-month lead time, meaning that the deal starts in month 7. Then we have month 7 and 8, and then month 9 will actually be when it closes. Now, let's say for this deal, the average close or average portfolio size that we're facilitating is, let's say, 10 million. And then we're not going to put in a growth rate here, but you can say, you want to in the future facilitate larger deals. If that's the case, you can put in a percentage here, and every year it'll grow the notional deal size. Notional just means the principal balance of the loan portfolio that you're facilitating. Okay, and then average tenure of portfolio. So let's say, these loans on average are maybe, credit card debt. It depends, but let's just say 24 months. And that is relevant for some of the ongoing fixed fees. And once this time period is up, those fees will stop. And there's potentially revenue and expense items that are tied to that. There's other things that are going to be tied to the notional value, but we'll as we get down here, you'll see. Okay, so $10 million loan, we're going to do 1 of them. We have an upfront fee. Let's say we're going to take 1.5%. So there's revenue, $150,000 in consumer fee revenue. Let's say we're also going to act as the placement agent and take a placement fee, or distribution fee as it could be called, maybe 0.5. Okay, so now we're up to $200,000 in fee revenue. Let's say ongoing service management fees. So this $10 million loan portfolio, it's going to pay back over time. The customer, or the people who have this debt will have repayments. They might default. They might early repay. You can define an average schedule down here for whenever a new portfolio is closed, how much of the beginning or previous month's principal balance is repaid. And this, I did a 60-month dynamic schedule, so you can make it vary, or you could just make it, here I'm just saying on average 4% per month is paid back. But it could vary depending on the type of loan portfolios you want to do, and it could be higher over time or lower, or go up and then down, or what have you. And to stop it, you can just put like 100% in any month. So let's say I wanted to pay, on average, pay them back in month 24. I'd just put 100% here. And then you'll see, if I go to my monthly detail, you can see the amount managed here, notional size, principal balance managed is going to go, and then boom, it goes to 0, and that in the life cycle or tenure of that deal is 24 months. And because there's going to be fees and revenues connected to that as well. So that's how you can use this schedule if you want, and that will apply to all the loans dynamically as they're added here. Okay, so anyway, management fee. Let's say we're going to take, this is a monthly fee, maybe 0.002. How much is that? That's pretty small, maybe 0.02. That's better. Um, and we have, fee analysis. You can see in the visuals. If we go here, you can see $7,000 in annual, 1610, and it's going down as that principal balance is dropping for over the tenure of the loan portfolio. But that's that amount. So you get an upfront fee and ongoing fees. Now you'll see, well, depending on how high your ongoing fee is relative to the upfront fee, it's likely your ongoing fees will actually outweigh your upfront fees over time, because obviously they happen over the whole tenure of the loan, and the upfront fees only happen once. But again, it depends on the percentages, and this is why the model is here, so you can test out different things. Okay, and then let's say we're also going to take a fixed fee, maybe $1,000 a month. Okay, so that'll raise up, or sorry, this is a annual fee. So if I were to put 10,000, it'd be 10,000 a year. So you can see if I zero out this, there's the 10,000. Partial is in year one, partial is in year two, and then you also got the upfront fee happening here. If I were to zero these out, you could see this adds up to 20,000 because it's a 24-month term. Ongoing average 10,000, so that's the math there. Let me undo this so it's back to how it was. $10,000, and this is a fee per deal. So if I had 2 deals here, now I'm getting 20,000 Nick, and everything's essentially doubled. Again, it's hard to see. Let me zero these out so you can see. So now, if I add up these, it's $40,000 over 2 years. If there's 2 deals, and the average annual fee is $10,000. Let me go back here, get the numbers in, put it back to 1. Okay. So those are all our revenue drivers. Now let's go to cost, because as the structurer, I have some costs that I have to bear in order to be the facilitator and do this legally. So let's say I get a rating agency fee, which is paid on at close, percentage of notional. Let's say it's 0.2. Okay, so there's that cost right there, 20,000. Let's say there's a minimum, so maybe 5,000 per deal. So this will take either 0.2% or 5,000, whichever is higher. So if this were like lower, you see now it's only 1,000, but if the minimum per deal is 5,000, then it's going to take that. And that tracks, if you had 3 deals here, now you can see it's 15, or, if this were a little bit higher, 0.2, 20,000 of 10 million, you got 3, that's 60,000, so I was choosing that. So that's how that dynamic works. Let's go back to 1 here. Underwriting placement fees. So this is, let's say road shows, investor outreach, deal syndication, logistics, bond distribution, if all kinds of things. So placement fees. So this is your cost to bear, and it's again just a percentage of the notional value at closing. We're going to get all that in there. Let's put maybe 0.1. So $10,000 here for 1 deal, 20,000 for rating agency. Now let's go to trustee and admin. So here we have an annual fee. Let's say it's $10,000. Okay, so there's your 10,000 per year. We've got 2-year tenure. So this is again going to be 20,000 total for that deal. If this were 36 months, you can see this goes to 36 total months, which would be $30,000. Put this back to 24. Alrighty. And so that's for doing uh, possibly administering the securitization trust or SPV over the life of the deal, including managing payment waterfalls, holding collateral, administrative agent fees for ongoing oversight, cash flow management, and escrow accounts. So again, in order to charge this ongoing management fee, you're going to have to do some things, and those things cost you money. So we're going to say on top of the 10,000 per deal per year, it's also going to cost us maybe 0.1% per month. That's a little high. 0.01. That's better. So you can see here our ongoing revenue. If we ignore the first year, ongoing revenue and ongoing expenses, we can see right here. All right, and then also you might have a one-time setup fee. Let's say you want to say every deal it cost us, let's say $25,000 as well on top of everything else. So you got one deal, so there's that 25,000. Moving on down, accounting and auditing fees. So let's say, third-party audits, agreed upon procedures on the securitized portfolio prior to issuance, verification of loan data, checking compliance with underwriting standards, verifying cash flows, all of that sort of thing. You obviously, you're providing this value to service to connect these parties to do the deal. And so part of that is doing that. So you're going to have this is paid with post-closing proceeds. But, and it's a hard-coded amount, let's say it's $100,000, you can, for working capital purposes, say a percentage of this 100,000 that hits at the initial onset of the deal. Now, let's say it's 25%. So that means 25,000 up front, 75 when it closes after 2 months. So if I started this deal in month 7, we go over here. Month 7, I close in month 9, and those fees I just entered, you can see right here, the accounting and auditing, I hit 25,000 as soon as the deal starts, and then I pay the other 75 post closing. Basically, that happens when all the other fee income happens. So that'll be relevant for understanding working capital requirements as well. Legal structure here, again, these are just hard-coded amounts. So let's say it's 10,000 for here, 50,000 for this. This will be one-time paid at closing. Well, again, this also has a thing, so you could do 25% up front. The other amount you have to pay at post-closing if there's a percentage. And you can see this here works very similar to the other one for legal and structuring costs. So this is what they're paying you to do, and you're going to have costs to do that. And then we have other direct costs paid post-closing per deal, other direct costs paid pre-closing, so just inputs to help. Okay, and then we move on. We have average percentage of principal defaulted on per month. So this is to figure out, the principal balance of these loans is going to go down based on defaults and principal repayments and early repayments. So the early repayments and scheduled repayments you could do here. And then this is just a separate input for default. So let's say, and you could watch how these ongoing costs and revenues are going to go down if I put, let's say, 0.2% per month. Barely dropped. So revenue went from 26,141. It was 26,447. So depending on the size of the loans and principal over time, this could be higher or lower. If it was 1%, that's a little bit more significant. You're now looking at 24,975, about $2,000 per year on a $10 million portfolio. So it is relevant though. When you're scaling a bunch of these, that could definitely add up. But or if you have a higher default rate, this would be higher. If it was like say 5% per month, which is quite high, that's insane. Yeah, now you're looking at a fairly significant amount of those ongoing revenues going down. Okay, we'll leave it at 1%. Now the tricky thing, we have another way you can make money in this business, and that would be through taking, let's say a bank wants to offload a portfolio. You don't have anybody to place them with right now, but you think you will be able to within some amount of time. You can buy the loans from the bank take them on yourself. And so that's going to cost money. So we could say percentage of loans that are going to require bridge financing, meaning you're going to do this. Let's say, we have one loan here, but you can think of it as percentage basis. So let's say if it was 10, and you're going to say 10% of these, so that's one loan is essentially going to be, we're going to buy the whole portfolio. So one loan of $10 million or one portfolio of $10 million, we're going to finance. We're going to pay 95% of the par. So we're going to buy that at a little discount. We're not collecting interest on it. We're gonna say, but we do got to buy it. So we're either how much of the loan are we going to finance with a bridge loan, which we're going to have to pay interest on. Let's say you finance half of it, so you come up with 50% of the money to buy it yourself. The other 50 comes from a bridge, and it's going to be 50% of 95% of that notional value of 10% of the loan settled for that month. So that's how that, that you can follow my logic. Just listen carefully. Um, Now, we also have the percentage of notional place. So this is now when you sell the loan to some group of investors or investor that wants to buy the security backed by the loans that you now own. So you're just essentially holding it for a little bit, but you could make a little margin if you can buy it cheaper from the bank and then place it at 100% notional, the full par value. But you do have expenses. So you're going to have interest expense, let's say 5%, and let's say closing costs on the bridge loan of maybe 1.5. Okay, and you can see here we have debt service of $39,000. That is this. So if this were 10%, you're now looking at roughly double. So interest expense, closing costs. Now the closing costs are actually going to roll up into your cost of goods sold basis. And so this is a non-cash item here. The actual cash is going to hit in, right, let's see, loan reduce here, loan purchase. I believe this is what is flowing into it. Let me go to the monthly detail real quick to see. So closing costs hit here, the hit cash flow, and then I think I put them all together in a so that when you actually sell the loans, your closing costs, even though you're paying them up front, they're getting recognized here in the future when you sell, like cost of goods sold. Where is it? Here. So you can see the closing costs, this 9571, and that's in order to get a proper EBITDA calculation when things are actually recognized. The interest doesn't do that. The interest expense is just going to hit regular interest whenever it's paid. Rate, you can see interest expenses happening right here over these 2 months. Okay, so there's at 9571. That's the closing cost plus what you paid for the loan. Here's your bridge loan proceeds, bridge loan repayment for those 2 months just to get you by. Now, I also did a calculation here on the executive summary to show the average gain or loss on the loan purchases. So on, let's say we ended up buying a $10 million portfolio for $9.5 million. Remember, 95% par. We did half of that financed with the loan. So we had to come up with the other amounts plus pay the interest expense and the closing costs. So that's going to flow right to equity, hit the equity. And depending on if you have working capital or not, it's going to make, in the early months, this will likely be a thing that increases your cash required if you're going to do this activity. Now, if it doesn't hit your equity, let's say you wanted to do 100% finance instead of 50%, you could do that. So here you can see it's 100% financed with equity. You're still paying now a little bit more interest and closing costs, but you're still profitable. Not 357,000 less the interest of 80. So you're still making a profit. Um, but the point is, you can model that if you want. If you're going to model some of the loans going through a situation where you're paying a little bit less than par, selling it for par, uh, that's another way you can make possibly a gain on or a profit. So that's there. You see gross profit analysis by asset class here. We're making $244,000 of profit in month or year one. And we've got the revenue from the loan sales here, and then the cost here. So that's all hitting above the line, because that is considered, if you're doing this this is considered normal operating procedures for this type of business. So that means your revenues and expenses, your revenues are the sales of the loans, your expenses are what you paid for them, your cost basis. So that's actually going above gross profit and above EBITDA. All right. So here, well, with one loan, we are, let's say, obviously we have these development costs, but let's say we didn't. You can see on a single loan, you're making $253,000 over 5 years with these assumptions. Now remember, let's say most of these are paid back by 24 months. You're now, ignore this, you got some taxes, you're now at 200,000. Not bad. And of net profit, it's taking you, if you look at the discounted cash flow analysis, it's taking you 600,000, but this is what you're getting returned over time. 27% IRR. So you could do this to look at a single deal, look at how you want to structure the ideal portfolio, and then scale it. But this is good to just see one, and you can see all the different math in financials behind a deal. And then I could just simply go, okay, that was 10. Oh, sorry, that wasn't 1, that was 10. If I did 1, you're at $20,000, taking 64. Still the same IRR because it's the same numbers, just less. And let's go back to the deal sentence. And that's pretty cool. And then you could say, okay, well, let's say we're doing one of these deals every month. And then maybe we start doing 3 deals a month. And then maybe 5 deals a month. So you can see now the numbers get a little bit bigger. Let's put this back in for startup costs. Okay, so you're still, that's not quite enough. Maybe you need to do bigger loan portfolios. Okay, that's enough volume. You're now getting a good return. But it's really, if you're in this industry, you will have data on all these inputs that you can put in here, and I think it's very valuable to see how adjusting all these different things can affect the P&L. Now, if I were to zero this out, saying, okay, I don't want to do any loan financing, my IRR goes down a little bit, and my ending cash goes down a little bit because those were profitable to do. Now, if you're paying closer to 100% on the notional and there's not enough margin there to cover your interest expense and closing costs, then it might not, you might not want to do that and just simply act as the middleman. You can still do all these facilitations, but you're not going to take on any risk at any point of the actual loan portfolios, kind of an intermediary step where you're going to hold them and possibly try to sell them for more than you paid the bank for, or whoever sold you the loan portfolio. Okay, anyway, so this is a great job. Let me put this back to 4%. At reducing the assumptions to single inputs that are very complex, and then showing how it affects the financials. All right, so that's the deal assumptions tab. At the bottom here, this also shows based on the percentages you put in each of these. It's just a way to say, well, if you started at principal of 1, after 60 months, here's how much is left of the initial principal. So it's just like a little helper to show you, like, this is what you think the portfolio is going to look like as far as principal payback over time, on average, for every new portfolio you facilitate. Which, again, is important for the ongoing fees that are based on the notional value being managed. Alrighty, well, that's that tab. These tabs M1, 2, and 3 are where all the magic happens. A lot of things going on here, complex financial modeling, and these are the frameworks I've developed to do models that work with these type of assumptions and are very accurate. Then we have OPEX tab. So this is corporate overhead. You can put in the start month here. Let's say, start month of 5. Set cost, maybe I'll spend $5,000 a month, or sorry, a year, maybe $50,000 a year on advertising. You've also got G&A items, R&D, some other percentage of it as function of total monthly revenue. Other direct fixed costs, again, have a start month and an annualized amount. You can adjust. A couple of these are adjustable by year. The others are manual. That's what the white cells are, just ones that manually or automatically change based on this percentage. CapEx we went over. You can put useful life and start months of depreciation for the software. Full-time employees here. Different employee types. The start month number, the count, annual salary, and annual adjustment of that salary, payroll tax and benefits. Also, I did up to 5 support or other staffing needs based on the number of deals started per month. So let's say if you put in 2 here, it means for every deal you need 2 of this type of employee. If their salary is $85,000. Okay, we go over the monthly detail. We can see that cost, and let's say they start. Well, here it's going to start as soon as you have deals. And note, I made this based on the start month because even though you're not closing these deals for, in this case, 2 months, you're going to have those salaried people working on the deals before you get the money from, your fees. So that's an important scaling dynamic that is better for planning your capital requirements. So you can see that staffing number is hitting right here based on the number of deals you're doing per month. And these assumptions. Here we're saying we need 2 people. So there's 2. You got their payroll tax and benefits plus their salary. Loan 2 and 3 are just regular working capital loans. You can define the loan amount. Say it's $250,000. We're going to have it draw on month 1. So that will hit down here. You see $250,000, then there's the principal and interest. You'll also be able to see that on the income statement. That'll hit interest. It'll hit balance sheet right here. Here's the bridge loans, which we zeroed that out, but that is also going to show up here, as well as the loan portfolio purchases, almost like an inventory item when you buy and if you're going to buy and sell them, that would show up there. Cap table. Again, you just need to make sure the minimum equity required, whatever that is totaled up into these 2 columns. I have a catch-all here, so any amount you don't put elsewhere will be here. But the total of this column from row 11 to 30 plus 35 to 54 should add up to this total. And then these percentages, if you add up both of them, should add up to 100. So let's say your founders are putting in 500,000. They're going to take probably more than that. Let's just say it's 60-40. You're going to give the investors 40%. And you can see what those cash flows look like based on what the business is able to achieve. But yeah, if you add up these, the total of both columns together should equal 100%. You don't want 1 to equal 100%. Like you don't want to have this equal 100 plus this equals 100, then you're going to double count. Startup costs, these are just other one-time fees. Terminal value, you don't need to do anything here. I usually just keep this at 100%. Monthly detail, this is where you can see how everything's flowing. And like I said, like I've done just consumer loans, but once you still fill out mortgages or the other two types that will flow through. Consolidated, here's your direct costs by type, total direct costs, total gross profit. Then we've got some other direct costs and our final gross profit down here. And remember, there's some non-cash items in here if you're doing the buying and selling of loans, which are added back properly in the cash flow row. Sales and marketing, G&A, your staffing, R&D, EBITDA, loans. Here's all your other activities. If you're doing buying and selling of those loan portfolios as well. And then final cash flow down here. Annual details, same thing, but on an annual basis. Here's our visuals. So revenue, gross profit, average fee rate relative to total notional managed. EBITDA, gross profit rate, average fee rate relative to total notional value closed. So this is just our 2%. And it would vary as you change these amounts and change the volumes and everything else. Annual revenue by type. So right now we just have fee revenue. EBITDA percentage. Cash flow. Oh, and this is another one I actually want to make the minimum on here 0. Cash flow per year, annual fee comparison. So this is going to show you upfront fee revenue versus ongoing fees. Debt service coverage, CapEx per year, assets versus liabilities, monthly cumulative cash flow, total assets versus total liabilities, annual view, annual fee comparison by percentage. So what's interesting, the ongoing fees start off small. And grow. They're still... Now, why is this showing more here? This is look at this chart here. So this is a percentage. Let's do this. So that's the same one we see right here. I'm just wondering why they're making the orange bigger when it's a smaller portion of the total. That's odd to me. Seems, doesn't it seem reversed? I'll have to look at this more. I might have to adjust this. That's weird. Monthly gross profit by asset class, monthly deals closed by type, cumulative deals closed by type, annual notional closed by asset class, year-end principal managed, and then annual gain loss on portfolio purchase activity. So this, if you did have some numbers here, let's say we did half the loans, we did that. Here's your gain or loss from facilitating, or taking on some loans and then reselling them. So fairly, 50 million, and you're seeing ending cash is up to 360 from 172. So yeah, about 200 million profit extra added. What else? We got IRRs here for the project investors and operators. That's going to run off of this discounted cash flow analysis, which runs off the cap table as far as who's getting what and how much they contributed. Here's the project up top, and then investors, owners. We have income statements. So here's all our revenue items, our direct costs, gross profit, net income, and then that flows over. You got the balance sheet. You can see retained earnings down here. Balance sheet annual. We got all our checks in. Cash flow statement kind of shows you where everything's coming from and how it's actually affecting cash flow each month based on what's going on in the business. And that is everything. So pretty complex. I spent about a week building this and quite a bit of time, maybe I'd say upwards around 30, 40 hours total. Um, if you do want to purchase it, you can go to the link below. I will be putting this in the general, so at smarthelping.com, we'll put it in the general industries bundle in the financial services section here. Also with our buy now pay later firm, that's a cool one that I did. So you'll be able to buy this individually as well for $75. Link will be in this section, or you can buy the bundle. You can also buy the Super Smart bundle for $4.99 and get everything on the whole site. It's an amazing deal. I've done hundreds of these templates. You can get them all. You can go to the financial models tab at the top to see everything I've done. There's many different startup models here across a bunch of different industries. I've done a lot of real estate modeling, joint ventures, general business valuation, accounting tools, all sorts of fun stuff. You can also hire me, $275 an hour right now. It's definitely not going down, my rate for this, but it might go up. I don't know. It just depends on how busy I've been. I'm pretty quick on the turnarounds, and you just email me, ask me or tell me what you're trying to do. I'll ask a couple questions to figure out. Usually I work in like 3 to 5 hour tranches with this prepaid. Um, but that's all I got for you. Um, I will look back. So on this chart, I'm going to look more deeply into this when I could just sit and think by myself and not on the video. But this chart, I don't know why this is backwards to me. I'm going to see, because this makes sense here at the beginning, but then why? Oh, wait, is it because the axis has a... Let me put this back to 0. Okay, there we go. So for some reason, Excel puts the axis... Sometimes they put a minimum randomly and not basing it like this should be 0. It should start at 0%. And now that makes... Well, so what it's saying is the ongoing fees are growing as a percentage of the total revenue, but they're still way less than the fixed upfront fee. But that's why it's getting bigger, which does make sense. But it did make sense before how it was actually growing bigger than the entire this section. But the reason why is because they were just showing you from 75 to 100%. I don't know why the heck Excel would think that's the best way to show that chart. I don't think there's any other percentage charts that need to be adjusted. On these, I had to manually do what I just did on that one. Oh, here, gross profit margin. Let's do that one. Set that to 0. I guess I can see why if it's a small percentage change over time, you might only want to zero in, but I think having 0% to 100 is the best for those things. Yeah, the rest of these look good. Okay, I'm glad that's solved, so I don't have to fix it elsewhere. It's just fixed. Yep, so if you buy the template, download it immediately. You can start using it. It's fully unlocked and editable. Just go through and adjust the yellow assumptions and build your financial projections. The benefit of these models, you can use them over and over. So you just have a base, your base version that's blanked out, and then every time you want to use it, just save it as a different, and just keep using it over and over. Oh, I didn't go over the executive summary. This is kind of another high-level view. Kind of like the deal assumptions, kind of like this over here, but it's just on its own, which is interesting to see some of the different returns. There's also this down here if you're going to buy and sell the loans. You can see your average margin, some charts. Okay. All right, guys, like and subscribe. This was quite an undertaking. I think the industry is very interesting. Definitely the model is, if you're getting into this, you're going to want to have a model where you can trigger and pull some of these levers to see how it changes and just run a full financial simulation. So I look forward to seeing how people end up using this and getting value from it, and I'll see you on the next one.